Hi, I'm James Daniel and welcome to Personal Finance FYI. Today is part 2 of our deeper dive into the concepts and strategies outlined in the Tony Robbins book, Money Master the Game. So you're ready to get started? Personal Finance FYI starts now. And welcome back to Personal Finance FYI, the web program designed to help you make smart financial decisions and to grow your wealth. On today's episode, we wrap up our discussion of the Tony Robbins book, Money Master the Game. Last episode, we covered some of the investment strategies that were outlined, and today we'll review both the annuity and private placement life insurance topics discussed in the book. Now, insurance-related products seem to be a very polarizing topic, both in the professional finance community as well as the retail investor community. You have some very vocal critics that say these products are high fee, high commission, but on the flip side, you also have a lot of supporters that claim they provide lasting financial security. As a fee-only planner, I really have no axe to grind in this battle since I don't sell these products. However, like any financial product, I look at annuities and life insurance as just another tool that is out there to potentially solve a financial need. Now, whether they are right for you depends on your personal financial circumstances. So, let's jump right into Tony's discussion of annuities. Now, an annuity is an insurance company product that allows you to put money into it and have it grow tax deferred, which simply means you don't get taxed annually on the income, much like your IRA or 401k, only at the point where you pull it out. At some point in the future, you either take a lump sum withdrawal or you trade the entire balance in for a promise of a monthly income stream, what we call annuitization. There are many different flavors of annuities. The first one that Tony covers is the most basic, and it's the immediate annuity, what we just spoke about. This is where you're simply trading a lump sum of money to the insurance company, and they're promising you a monthly income for the rest of your life. Basically a pension plan. Fairly straightforward, and if you like the security of monthly income that you cannot outlive, then this can be potentially a tool for you. The second type of annuity he discusses, and the one that generally gets the most heat, is the variable annuity. This is where you put your money in the annuity and select a portfolio of mutual funds, or what they call sub-accounts, to invest in. On its own, there is no guarantee of what your money will do. Your investment will rise and fall with the markets. However, the insurance company offers add-ons to these annuities called riders. For a fee, they will add some guarantees to this variable annuity. One guarantee may be a minimum guaranteed return if you annuitize this product in the future. And these riders and their fee is typically where the rub comes in with annuities, and that is once you layer in all the fees, is it really a worthwhile product? Once again, my opinion is that these are tools, and in certain cases, they do provide a benefit. Now, another type of annuity that is discussed in the book is a fixed annuity, which, just like it sounds, offers a fixed rate of return. And finally, the last annuity discussed is the index annuity. These products tout the ability to participate in some of the market upside with no downside. To do this, they have to invest in futures contracts routinely throughout the year to try and capture some of the gain or market upside while parking the bulk of your assets in treasuries. The rub here is that these can be tricky, and even if the market is up on the year, you may not have a gain, as it all depends on how your participation is structured. So it can be from month to month, quarter to quarter, or at specific annual endpoints. In the end, an annuity is a tool that may or may not be right for your circumstances. Yes, they are higher fee products, and they may have many restrictions and lockup periods, but it may be a good tool for your specific need. At the very least, read the fine print and educate yourself before purchasing. So the last topic that Tony covers in the insurance world is what he calls private placement life insurance. Now, I've been in the business a long time, and when I saw this, I was stumped. I'd never heard of any life insurance product with a name like this. But when I read about the features and benefits, it sounded exactly like a variable universal life insurance policy to me. Now, a variable universal life policy is also called a VUL. It is the cousin of the variable annuity, in that it is life insurance that you put a larger amount of cash into and invest it in mutual funds, or what they call sub-accounts, inside the policy. Now, Tony calls this the rich man's Roth. The reason for this is that if these policies are structured correctly, anyone, even high-income earners that cannot contribute to a Roth, can put money in these and at some point in the future get money out tax-free. So you're asking, James, how can I get money out tax-free? Well, here's how VULs are supposed to work, and in many cases they may, but you need to be extremely careful. The idea is that when you buy into this insurance policy, the insurer will give you a minimum annual premium amount, and they will also show you the IRS maximum funding amount. If you stay between this area and dutifully fund this policy for many, many years and your investment choices cooperate, then at some point you build up enough value, the insurance company will let you take a loan from the policy that you may not ever have to pay back. And that is essentially a tax-free distribution, sort of like a Roth. Now, this doesn't mean that you can't stick more money into these kind of policies, but if you go above a certain threshold, then the policy becomes a modified endowment contract and any withdrawals are going to be taxed. Once again, I've seen cases where this type of insurance has served a great purpose, and I've seen also many cases where clients did not understand what they had been sold and it ended up being a very costly mistake. In the end, annuities or cash value life insurance policies are just tools that may or may not be right for your circumstances. At the very least, always read the fine print and educate yourself before purchasing. Or simply find yourself a fee-only financial planner to help you determine if these products are right for you. Until next time, I'm James Daniel, and I will see you on the next Personal Finance FYI.